Thank you very much for coming. I think, I'm a little bit out of place at this conference because this presentation isn't about gold or, the bulk or the base commodities. This is about energy, and specifically some energy metals and how we see the energy sort of system, global energy system, evolving over the coming decades. One of the things that we have seen is a lot of heat and a lot of hype. And so one of the things that I'd like to try to do today is dispel some of the challenges, dispel some of the, I think, misgivings and misunderstandings, and really give you guys an idea of how we see energy and commodities creating opportunities going forward. So just very briefly about myself. About 6 years ago, I'm based in New York. And by the way, I just got off a plane this morning, so if I start to babble or say something that's incoherent, just bear with me. But about 6 years ago, I founded an independent research shop, and the idea or the goal was to focus on what I call energy metals. Okay, that's a specific niche in the commodity space. That's any metal or mineral that's used in the generation or storage of electricity. So I do a lot of work with lithium, with cobalt, with graphite, with vanadium, with rare earths, with a lot of these niche metals and minerals that are really misunderstood and underfollowed and about to become much more popular based on demand in energy applications. And so that's really what we do. We're top-down, thematic-driven research providers. So we'll look at macroeconomics, we'll look at demographics, trends like that, and try and chart a course forward. And that's what I'd like to do with you today. And you can see, by the way, we have a blog, so you can go there and take a look at that. And the organizers were kind enough to give me 40 minutes today, and I can guarantee I won't be going that long, hopefully 25 to 30, so we'll have time for Q&A. But in the event that I don't get a chance to meet with you or chat with you afterwards, you can see here's how you can contact me if you're on Twitter or LinkedIn or email. Okay, so questions to consider. One of the things that we do in our research is try and look back throughout history to try and find some parallels for what may have been going on at a specific point in time in history versus what's happening today. And many of you in the audience will be familiar with this idea of a great game, a geopolitical great game. And so we'll talk a little bit about that because we think what was happening at the turn of the 19th century into the 20th century draws a lot of parallels in terms of where we are in the energy space today. And then talking a little bit about what forces are at work in energy evolution and energy storage. And of course, like I said before, the difference between truth and fiction. Okay, hype versus reality. And then ultimately this is an investment conference, so talking a little bit about what are our due diligence steps, okay? How do you play this going forward if you buy into the thesis that I'd like to share with you today? Okay, so again, the great game, there were probably a lot of people in this room that could teach me a thing or two about it, but this was a geopolitical battle between Russia and the United Kingdom, and what was at stake in the late 19th century was access to sea, access to trade routes on land, okay? So it was a geopolitical battle, and what was happening at this point in the global economy was you were starting to see lifestyle improvements. You were starting to see people live longer, healthier lives. And one of the outgrowths of that, or the outcomes of higher quality of life and more trade, was an explosion in various technologies. And one of those interesting technologies came from this gentleman. For those of you who don't recognize him, this is the father of the electric vehicle. This is Ferdinand Porsche, okay? And he, of course, was widely credited with inventing or building not just the first fully electric vehicle. A lot of people don't realize that the first Porsche was an electric vehicle. But he also built the first hybrid, and you can see this is actually the electric drivetrain. Doesn't look like a Model S, but the same fundamental technology is there. This is actually in the Porsche Museum in, I think, Stuttgart today. So, this specific technology came around, like I said, in the late 19th century. So it's not new, but of course, this explosion in technology, these incremental increases in new technologies, were an outcome of increasing trade and increasing or higher lifestyles. Here's another one. We all know who this is. This is Albert Einstein. About the same time, okay, as Ferdinand Porsche had invented the first electric vehicle, Albert Einstein wrote several seminal papers, one of which was to really not so much discover, but really eloquently discuss the photovoltaic effect. In other words, how to take sunlight and generate electricity from it. So electric vehicles, and that's really one of the first, I think, issues to really talk a little bit now about when we separate heat and hype from reality. A lot of these technologies that we're excited about today aren't new, okay? The issue up until recently is they weren't really economic, okay? And that's the one thing that is starting to change. And so the opportunity to apply them, the opportunity to create new supply chains based on these new technologies, these new energy technologies, is what is actually really exciting for a lot of people right now, and we think sets the foundation for a number of I guess, rosy projections for various metals and minerals that we'll talk about here in a couple of minutes. So, you know, if we take a look at the technologies that are now becoming more ubiquitous, whether or not it's solar with batteries or vehicle electrification, the way we look at it is we're calling this the new great game, okay? So here we are 100 or 115 years later, and there's a new great game now. And you've really got 2 or 3 groups of companies, okay, that are fighting for market share. So if the original great game was for countries fighting over geopolitical advantages, our argument is that the new great game, as we're calling it, is about companies and about market share. And these types of companies that you can see here, the Apples, the Teslas, the Googles, are the insurgents. And that's a phrase that actually came from Amory Lovins, who is a think tank representative at the Rocky Mountain Institute. And so these are the younger companies that are more focused on technology and going head on into old, staid industries, like, for example, the automotive business. And so these companies, and by the way, this is by no means a complete list, but these companies want to go head-to-head with the incumbents. These are the companies, General Motors, Nissan, Mercedes-Benz, that have been around for decades. They have supply chain mastery, but they don't necessarily have the technological prowess that a Tesla does, for example, although they would probably argue that. And so, you know, how these groups battle over the coming weeks, months, and years and decades will really determine what the energy infrastructure, and again, how we use energy for mobility going forward, turns out. And so there's one more group, and I'm calling these the hybrids, okay? These aren't exactly technology companies per se. They're certainly not in the automotive business, but Samsung, LG Chem, I mean, these companies are all starting to integrate with other automotive manufacturers going forward. And so these value chains that I'm trying to describe to you, these next generation value chains, are not yet set. And that's really the fundamentals for the new great game. Speaking of fundamentals, this is why people are so excited, okay? World transport energy use has doubled over the last 30 years, and it's forecast to do the same over the next 30 years. And so when you start to think about some of the macro forces, demographics, convergence that we'll talk about here in a few minutes, sustainability really comes to the fore. We're going to see a lot in the next week or two about vehicle electrification and about sustainability and sustainable energy growth coming out of Paris next week. That's going to be something very interesting to watch. And one of the other, I think, maybe misconceptions surrounding a lot of the heat and the hype with vehicle electrification is that it has a long way to go, okay? It's not going to be a straight line. It's not a linear progression, but you can see this is world transport consumption by fuel. It's from 2012, so it's slightly dated, but you can see that fossil fuels obviously dominate world transport consumption right now, and they will for decades to come. The exciting thing is that electricity, you can see, is about less than 1% of the global, I guess, percentage on an energy equivalent basis. So this pie is going to get bigger, but the electricity portion is going to grow, and it's going to perhaps grow dramatically. So one of the questions that we always get when we look at a lot of these really exciting statistics is it different this time? Okay, and almost always the answer is no. Okay, and the difference, however, though, is now we're starting to see some of these macro trends, some of these forces that I'll discuss in a couple of minutes, really converge to create new opportunities. And you can see here, excuse me, the economic theory of convergence is just as prevalent today as it was during the original Great Game, okay? And now this is not something that I came up with. The idea, the theory of convergence came from a gentleman by the name of Michael Spence, who's an economic, actually is a Nobel laureate over in the United States. And so, you know, we could spend 40 minutes just talking about this, but what he's really saying is, look, over time, as the global economy grows, population grows, demographics play out, trade barriers fall, and most importantly, technology advances and proliferates, living standards over time between East and West or North and South, they tend to merge. Okay, and we'll look at some data here in a minute. But this, of course, has implications not just for resource demand, and not just how we grow, but global quality of life. And again, we'll take a look at some data here that we think backs that up. So the first really, I think, macro trend underpinning convergence is urbanization. Okay, and this has been talked about a lot, actually, on the panel that I was just on. We were talking about it, but what we're looking at here is urban population as an overall percentage of the total population, okay? So typically throughout history, as any society has urbanized, they have become more commodity and more resource intensive. And we're looking at 4 countries here, and then they've got the global average, Canada and the United States up at the top. And by the way, the UK roughly parallels the US and Canada. But you can see our quality of life, in other words, the urban population as a percentage of the total, we've effectively plateaued. And that is not the case when you look at India and China going back to 1960 to today. So, you know, this is not a linear progression. I mean, perhaps one day in the distant future, the Chinese will catch up to us. But the point is that this gap, this sort of band, if you will, right here, has narrowed, and it continues to narrow dramatically. And again, just to give an idea of what that looks like, we call this the catch-up potential. And you can see I thought this was interesting. This is GDP per capita for the entire continent of Africa, okay, and then China and India. And you can see how that compares to the US and the UK. So this is per capita GDP in US dollars in 2014. So there's still a gigantic gap to be filled. And so this is where technology, and again, thinking about how we utilize and generate and store energy going forward is going to become very, very important. And so, you know, technology, there are a number of different examples of how it's positively affected society. This is a chart actually from the second machine age. This is a book written by 2 MIT professors, but what it's showing us is that it says basically for as far back as they could get data, which was 8,000 BC. Don't know how they got that, but nevertheless, there was really very little change in the average quality of life. Life was truly nasty, brutish, and short. And then ultimately, you can see things took off in 1775 with the introduction of the Watt steam engine. So, you know, I would submit to you that this line, this trajectory is not sustainable. And again, it's going to force us to rethink about how we generate and utilize energy. And of course, China, amongst more so than I think any other country out there, is more focused on this than anybody else. And this is a perfect example of the reason why. This is a finisher from the most recent Beijing Marathon, okay? And there are plenty of pictures like this. The pictures like this showed up on the front page of the New York Times. And so, you know, the Chinese, more than anybody else, I think, realize that they have a huge environmental and industrial problem. And so a lot of the growth and a lot of the technology and a lot of the application is going to come from and exist in China going forward. And we've already started to see that happen with last year, actually, China installing more renewable capacity, renewable electricity capacity than the US, France, and the UK combined. So urbanization is barreling forward. It doesn't matter if China grows at 10% or 6%, okay? Second interesting point is technology, okay? I talked about this earlier, and technological adoption is accelerating, all right? And so there are a number of different ways to look at this. I just chose one specific example here. This is how long it took 1/4 of the American population to use a given technology once it was introduced. So it took in 1873, it took 46 years for 25% of the American population to use electricity for the first time. And you can see how that has shortened dramatically. And I just used the United States here. I mean, you'd find a very similar chart here in the UK or in China as well. So, you know, as technology becomes ubiquitous, it starts to proliferate and, again, merges living standards going forward. Now, I just want to take a slight detour, all right, and talk a little bit about our view on the global economy, because I think it's important. You can't have a discussion with energy or electricity or anything like that and try and forecast the future without thinking about what's happening in the global economy right now. So, you know, this change, this positive change, we would argue, is occurring against a backdrop of a pretty challenging global, gloomy macro environment, okay? Our view is that the commodity supercycle that run up from 2001 to 2011 is over, okay? The growth adjustment that China has to make from investment and exports towards more consumption has been slower and more painful than I think a lot of us would like. And a lot of that has to do with leverage and debt on balance sheets, whether or not that's sovereign balance sheets or corporate balance sheets. We've seen a lot of blood spilled in the mining space because of too much leverage. And so what this all really means is because China is really central to global growth and also commodity demand, you're looking at pretty sluggish global growth prospects going forward. And again, this is just another way of looking at it. This is from the Wall Street Journal. But what it's showing you is how important China is to metals demand, okay? 54% of all aluminum is consumed by China, 50% of all nickel. So, you know, yes, I buy the argument. Everyone says, well, China's growing at 6%, but that's still growing from a much larger base. And that's true. But nevertheless, you know, the numbers don't quite add up. And of course, China's a little bit of a black box from an economic perspective. So as China's growth rate has fallen, okay, and there's a lot of slack in the global economy, nowhere to pick that up. This is why you've seen nickel and copper and a lot of these other metals get really, really hurt. So excess capacity means lower for longer, to borrow a phrase from Goldman Sachs. There's enough excess steel production capacity right now in the global economy to build 75,000 Eiffel Towers every year, okay? So I'm just trying to hammer home the idea of an overhang, whether or not it's from debt or from excess production capacity. And this is what we need to work through to really start a new commodity cycle, okay? So, you know, that's the bad news. And the good news is that there's a ray of hope. And so, you know, from our perspective, when you think about the global economy, you know, everyone has their opinions. It's inflationary, it's deflationary. We're firmly in the deflation camp right now. We just think that the excess debt and a lot of the excess capacity right now and the slack in a lot of the labor markets is going to overhang. It's going to act as a real overhang on the global economy. And so the difference, though, is that when you're talking about deflation, and this is the ray of hope, there's good deflation and there's bad deflation. And what's happening in the metal space is actually, in our opinion, contributing to what we call good deflation. In other words, falling prices of raw materials ultimately mean cheaper end products for consumers. And what we're looking at here, all right, is the battery price, the lithium-ion battery price, going back from 2006 to basically last year, per kilowatt hours, okay? And so it's falling by about 14% per year. A lot of that has to do with scale, a lot of it has to do with technological advancements, but this isn't a Moore's Law phenomenon, but the good news is that if it continues to fall at this pace, sometime before 2020, you'll see lithium-ion batteries, you'll see electric vehicles that will meet or beat the traditional internal combustion engine on price and cost and reliability. So that's one of the reasons why we think the next 5 years in the lithium business in particular, in the battery business, is so exciting. And here's another one, coming back to the whole energy theme. This is the decrease, the price history of a silicon photovoltaic cell in dollars per watt. It's absolutely collapsed, and it doesn't look like much is happening over the last few years, but again, whether or not you look at it on a utility scale or a homeowner-specific scale, the prices of these new energy technologies are continuing to fall. So you're starting to see solar paired with batteries, for example, in certain parts of the world that is competitive with traditional fossil fuels. And again, there's the subsidy argument. I'm fully, we can all admit that. But nevertheless, my point is these trends are all going in the right direction. And at the end of the day, what it really means is increased raw material demand. So when you see these energy technologies, if you will, start to fall in price, I thought this was very interesting and very appropriate for this audience. This was from the front page of the New York Times about a week and a half ago. Britain to close coal-fired power plants by 2025. Obviously, there are nuances here, and I won't pretend to be the expert on the British coal infrastructure. But nevertheless, I think with Paris coming up, there's a little bit of political posturing here, but the economics are changing, okay? That's very, very clear. And so you're starting to see countries say, well, okay, so if the prices of lithium batteries, the prices of solar, the prices of wind, biomass are starting to fall and fall rather precipitously, this means more renewable electricity generation capacity. And where will it come from, or where will it be deployed? Obviously, the emerging markets. You can see non-OECD versus OECD. The good news is that more of these, I call them the new energy technologies, will be deployed, but obviously they'll be deployed in non-OECD developing markets, and that has everything to do with the fact that the energy infrastructure in that part of the world isn't as developed as it is here. So it's easier to replace or easier to start from scratch. So again, very, very positive signs going out over the next several decades. And finally, just to hammer this home, this is another example of cost, what we would call cost deflation in action. This is a forecast of the global lithium-ion battery market. So this isn't just electric vehicles. This is handhelds, this is tablets, this is everything. And right now, it's about an $18 to $20 billion a year business. Globally, the battery market globally is, close to 80 billion. Some people would argue that. And so if the trends that I'm describing to you are accurate, and if they continue on this path, you're looking at a global lithium-ion battery business that's going to be worth about $90 billion in 10 years. And that's, of course, bigger than the entire battery business is today globally. Okay? So when you start to talk about supply and demand, obviously the next question that I think comes to everyone's mind, and certainly comes to our mind, is there enough to go around? And that's a commodity-specific question. And again, to keep it relevant to the audience, this is a slide of resource dependence, UK resource dependence from the British Geological Survey, essentially showing how reliant you are as a country on various critical metals and critical minerals. So rare earth elements, tungsten, antimony, and again, each element has its own supply and demand dynamic, but I would point out that there's one country that is going to become much more prevalent in terms of how these supply chains are built, and that is, of course, China. China holds the cards. This is, again, another slide from the British Geological Survey showing that China China is the majority producer of 22 they call elements of economic interest. And so that's a pretty interesting, I think, pie chart because they dominate everything else. I don't even see the UK on here. The USA is only one. So, clearly China is going to continue to remain a huge factor as we build these new energy supply chains. All right. Now, I haven't mentioned oil. I haven't mentioned OPEC. Part of that is just in the interest of time. We can certainly chat about it later. OPEC is in trouble. Okay, at $40 oil, almost all of them are underwater. Now, I just want to be clear on this chart. This is not profitability. This is showing you, this says, okay, well, given each country's spending plans, so, social insurance, defense, what oil price does that country need to break even? You can see Saudi Arabia. By the way, the red lines are non-OPEC members, but you can see Saudi Arabia, for example, the biggest, sort of most influential OPEC member, needs $100 oil to satisfy all of their current spending obligations. So you've seen them sell assets in their sovereign wealth fund. You've seen them go into the bond markets to borrow to try and win, if you will, this game of chicken with the U.S. shale business to try and figure out who the new swing producer in the oil market is going to be. So it's another interesting thing to watch going forward. Okay, so just to finish up, so we've talked about a lot, and I've thrown a lot of data and ideas at you. When you're looking at companies, okay, what is important to us? What do we think are the biggest issues? And again, we're talking about the commodities that are crucial for these energy technologies. So obviously lithium, graphite, cobalt, they all come to mind. Many of these metals are controlled by oligopolies. Okay, and lithium is one such example. You've got a sliver of maybe 4 or 5 major producers up at the top. And so, you know, I see these rosy forecasts of lithium carbonate or lithium hydroxide prices going to the moon in the next couple of years. And my personal opinion is that's not what's important. When you're dealing with an oligopoly or a monopoly, you have to meet them or beat their cost of production. It doesn't matter what the price is, okay? It's not necessarily about the margin. It's about meeting these guys and going from there. All right, so number one, many of these are oligopolies, and cost of production is, in our opinion, what matters most. Secondly, you know, I wish that a lot of these metals were like gold, in the sense that you just mine it and pour it and throw it in a vault, and that's that. But you need an offtake agreement, okay? Whether or not that starts off as a memorandum of understanding or it's a binding MOU where an end user agrees to take a certain tonnage per year at a certain price, that's an absolute necessity. You can have a cobalt producer, for example, that can produce an amazing concentrate and so on and so forth, but if they don't have anybody to sell it to, it doesn't matter. It doesn't matter, okay? It has to go to an end user. And then finally, you know, Amanda talked about this in her presentation. We are particularly bullish on what we would call late cycle commodities right now. So lithium, again, to hammer that one home, cobalt, and also scandium is another interesting one. But, you know, those three that I just mentioned aren't as dependent on China and China's growth as copper or as iron ore are. So we think that the later cycle commodities, unfortunately, majority of them are used in these energy technologies, are going to outperform over the next few years. Okay, so again, just to bring this back to this whole idea of a new great game, and this is by no means the only players on this list, but these are the main players. You've got the incumbents, the insurgents, and the hybrids, and how these companies either work together or against each other is going to determine, again, not cost of energy for all of us, but what the energy future looks like going forward. So with that, I will go ahead and end, and I'm happy to take any questions. I know I threw a lot at you, so thank you very much for your time and your attention. Any questions? Sure.
China-led One Belt, One Road promise.
Right.
And you Silk Road. So you're talking about they're connecting 1 billion people, and they're spending something like $500 billion on those projects. So don't you think that's a prelude to a new commodity cycle the next few years from now?
So the question is the Chinese, the One Belt, One Road policy, and is that the catalyst for the next cycle? You know, I would say yes, but again, I think a lot of people, and I fell victim to this, I think a lot of people underestimated the amount of excess capacity in the global commodity cycle right now. I mean, that slide that I had where there's 500 million tons of excess steel capacity, I mean, that is going to have to get worked through or used before we can really find new equilibrium prices for iron ore, for example. So longer term, yeah, the One Belt, One Road policy, everything that China is doing with the Asian Infrastructure Bank, Infrastructure and Investment Bank, the One Belt, One Road policy, the BRICS Bank. I mean, again, longer term, out over the next few decades, I have no problem with copper going back to $3 and staying there or higher. despite the rut that we're in right now. So yeah, China's infrastructure, the interesting thing about China is their infrastructure goals aren't as internally focused anymore. To your point, they're looking at connecting, the old Silk Road, which to your point is about 2/3 of global population right now. So longer term, yeah, very optimistic, but it's just sort of a challenge out of the next, 3 to 5 years. Anything else? Sure. Nuclear power and uranium. Optimistic. I sort of chuckle when I say that, only because there really is. We talk about renewables and how exciting and clean they are, but of course, they just do not suffice as baseload power. Okay, and so there's obviously only so much hydro to go around as another baseload source, but you need 180 million pounds of uranium, again, just to stay where we are today, and that does not include the growth in China, which everyone, I think, falls back on, but other parts of the world as well. So, nuclear power and uranium in particular have a PR problem, and a lot of that is, I think, Fukushima-induced fear. But when you look at a lot of the new reactor technologies in particular, they're much, I don't want to say safer than reactor technology from the 60s or 70s or 80s, but they really are. And so, it's just, I think, a question of moving beyond some of the concerns around Fukushima. But yeah, uranium at $36 a pound right now is long-term not sustainable, not at all. So I would say, in the next 2 to 3 years, you could see $50 to $55 uranium, just sort of a forecast.
On that topic, Chancellor Osborne on Wednesday here in the UK released his August statement. In it, he mentioned quite significant interest for small modular nuclear reactors. Do you share his excitement?
I would want to look at what he said, but that's the way to go. By the way, the question was small SMRs, small modular reactors, and Chancellor was excited about it. Do I share the sentiment? I mean, it makes a lot of sense. One of the other challenges with uranium and nuclear power in particular is, okay, so if we want to build a nuclear power plant, it's multiple billions of dollars, and there are cost overruns, and they take years. Whereas, and I'd be interested in reading what he said, but small modular reactors obviously have different technologies. They can shut themselves down, for example, if there's ever a problem. And again, it's smaller, but it's scalable. So again, longer term, I think uranium is probably an interesting place to be.
For the UK, we've got lots of shale. It would make a lot of sense probably for the UK to use shale, carbon capture, carry on with fusion development. That would give us 30, 40, 50 years to get fusion. Because nuclear is always PR hazard. Because any nuclear reactor is a fission bomb under control. It's got to be its minimum size just to start working.
Right. Right. So I think the question or the point was shale here in the UK as and carbon capture as a substitute for nuclear because like you said of the PR problems. Yeah. The shale business, I can't really speak to it here in the UK, but certainly in the United States, a lot of people believe that the shale producers in the US are the new global swing producers. In other words, it's not the Saudis and it's not OPEC anymore. The challenge over there is that you have about $230 billion in debt that these shale producers have racked up. So, can we see a rebound in the oil price to allow these companies to sustain themselves? Or, are the Saudis right, and are they going to bankrupt the space? But yeah, you're absolutely right. I mean,
And in the long term, nevertheless, move to an electric-driven economy when we get battery technology.
yep, and the battery technology. If somebody can find a battery that with my phone. You know, I don't have to carry an extra battery around with me all day long, whether or not it's for personal use or for automobiles. And they're going to be very, very rich.
In the only last 2 years, having a Tesla full battery changes every 2 years.
Right. So, you know, the battery technology, the good news is the battery technology is improving. I think one of the challenges is, and that you actually raise a good point, you know, the battery technology is improving, but it's also changing. And so, you know, you've got a number of different lithium-ion chemistries, for example, and so you've got Tesla building their gigafactory, and you've got these other Asian battery manufacturers that are also building their own mega factories. You know, will lithium-ion be the optimal battery chemistry in the next 5 to 10 years? I mean, that's an open question. It's an open question right now, and that, of course, I think has potential to affect your investment decisions. Because, like I said, just because we use, you know, X% lithium in a given battery right now doesn't mean that we will 5 or 10 years down the future. We could end up using more. I mean, we just don't know yet. So, anything else? Okay, thank you all very much. I appreciate your attention.